Welcome to the ICAEW Insights podcast.
Hello and welcome to the ICAEW Insights podcast, where we analyse the latest news from the world of accountancy, business and finance. I'm your host Tom Herbert, and in this episode we're focusing on the UK's Autumn Budget 2021 on the 27th of October. Normally one of the biggest financial events of the year in its own right, this budget has assumed even greater significance, being the first since the easing of lockdown measures and the tapering down of a number of key COVID support schemes, and also because on the same day we will see the first 3-year government spending review in 6 years. Joining us to guide us through the fiscal fog are experts from across ICAEW's tax and public sector team. First of all, I'd like to welcome Alison Ring, Director, Public Sector and Taxation at ICAEW. Hi, Alison.
Hi there, Tom.
Thanks for joining us. So, Alison, what are we expecting on the 27th?
As you just mentioned, we're going to see the first 3-year spending review, the first time in 6 years. We're going to see a budget for the financial year starting 1st of April 2022. There'll be financial projections for the next 5 years, many new fiscal rules, I think, as well, and a plethora of other stuff, such as the integrated rail plan and I presume budgets around HS2 and plans around HS2 as well.
Goodness, a lot to get through. Thank you, Alison. More from Alison a little later in the show. Let's move to tax now, a traditional area of focus on Budget Day. To run the rule over what we already know and what may be announced in the Chancellor's speech are Frank Haskew, ICAEW's Head of Tax. Hi, Frank.
Hello, Tom. Nice to be here.
And Anita Monteith, Technical Lead and Senior Policy Advisor, Tax at ICAEW. Hi, Anita.
Hello, Tom.
Now, it's possible that the year's most significant financial announcement has already been made earlier this month via the new Health and Social Care Levy. We've covered the details on the ICAEW Insights website and the tax faculty pages, but I'll start with a statement, if I may. This was quite an unusual policy in a number of different ways.
Very unusual. I think we're still trying to get to grips with really what was the background to it and why they adopted the approach that they did. I know Anita has a number of thoughts on it as well, and I won't want to steal her thunder, but for example, the bill passed its House of Lords stages on the Monday, the 11th of October, and the House, or the Lordships, had quite a lot to say about it, as you probably would expect. But there was a comment, I think it was by Lord Forsyth, which I thought was an interesting take on it, which was that he felt it was like going into a restaurant and being presented with the bill before he'd actually even been given the menu, which I think was quite an interesting way of looking at it, because we seem to have had this new tax presented to us as a sort of rabbit out of a hat, if I can use that expression. But we haven't, for instance, even had the white paper on social care, which is meant to be one, the government's been talking about this for, I think, 10 years or more, and we're still waiting for it. So it seems extremely odd to have introduced a provision like this literally overnight, when a number of the sort of parts of the jigsaw, if you like, haven't even been shown to us as yet.
Not normal tax policy making, Anita.
Absolutely not, Tom. I think this is exactly how you don't make policy. If I say that we have got more than 50 questions already tabled with HMRC on the detail of the new Health and Social Care Levy, you can see quite how much is still unknown. The legislation itself was beautifully concise, covered less than 1 page. But, of course, concise legislation leaves a lot of questions unanswered. I think for my money, the reason why the Chancellor has done this, and done it by playing around with national insurance rates quite so quickly, is that we need the money. And it takes time to build a system to bring in a whole new tax, which the Health and Social Care Levy is. So what he's done is to simply raise all of the rates of national insurance. Now, of course, that sounds simple enough. If you put 1.25% on the employee's national insurance and the employer's national insurance as well on the same £1 of wage paid to an individual worker, that makes 2.5%, not 1.25%. And if we just remember the debates we have all been having for the last few years about the different ways that the employed and the self-employed are taxed, and some of the very, very difficult problems we still have to address there, you can see that this has simply widened that gap. So I think this is a very bad way to make tax policy, because we are after simplification, and ICAEW and its members are keen to take part in the debate on tax simplification. This is not it.
And there was also a rise in dividend taxation. Is that correct?
Yes, so dividend tax is also going up by 1.25%, but we haven't yet had the legislation for that. That will presumably be in the finance bill for next year. So we're still, the jigsaw, we're still waiting for some of the pieces to be actually shown.
Yes, and there are some secret things thrown in there as well, aren't there, Frank? Like there was the throwaway comment that we would ask software providers to add a note to payslips to explain to people what this new levy or tax was all about. Quite extraordinary. If you look at your payslip, you'll see that there are no messages on there at the moment. So this would be a real change to the sort of information you would have on your monthly payslip. Quite unusual.
In terms of overall numbers, it's going to be raising about $6 billion a year, which in the scheme of the total NHS budget, which I think is sort of north of 125 billion, it's a drop in the ocean. So on the face of it, we've had two buckets, if you like, so far, income tax and national insurance, and now effectively we're going to have three buckets. But I don't think it's at all clear that it's really a hypothecated tax in the proper sense of the word.
Yeah, because it was certainly billed as one, wasn't it? That the health and social care levy would go into that. Is the dividend tax, is that hypothecated as well?
Well, I don't think we know the answer to that as yet.
I'm not sure how they could
No,
hypothecate
I don't think they could.
No, I mean, it just goes into the general tax collected pot.
There would have to be a separate finance bill provision, I guess, but it would be such a small number that it will be lost, I would have thought.
I think we should also explore some of the unintended consequences of these changes. For example, when this is rolled out next year and becomes the health and social care levy rather than just extra national insurance, it is going to apply to older workers, so people above the state pension age who will now be paying what is effectively national insurance for the first time. Now, a lot of people above state pension age are working now who perhaps weren't before. We were encouraging people to work to help subsidise their older age as they live longer.
Higher costs of it.
Yeah, I mean, do you think this is still going to encourage people to keep working, Frank?
I think it will discourage people, won't it?
I think so too, yeah.
I think it will.
Be very interesting to see what the reaction is.
And in terms of international obligations, where does this sit in there?
Well, national insurance has always been a problem area for overseas workers. And I mentioned earlier that we have something like 50 questions outstanding, and there are quite a number of those that relate to overseas workers and whether the new levy will apply to them.
And I think just finishing that off, it shows you that introducing a new tax without any consultation, I think, is a very bad idea, because the fact is we're just at the start of the number of difficulties and questions that potentially we could have resolved, I think, if there'd been a proper consultation about this.
Let's move on to making tax digital now. Three words that in the pre-COVID era dominated discourse in certain areas of the profession. The government announced back in September that the start date for making tax digital for income tax self-assessment had been put back from 2023 to 2024. In practice, what does that extra 12 months mean for implementation?
Well, I'm all about dates as far as MTD is concerned. I think it is very good news that we have a little extra time before MTD starts, but I don't think it's going to be enough time for the very, very many people in this country who haven't even started yet to digitalise their accounting systems. The most important date that I think everybody should take from this is the digital start date. And the digital start date now for all businesses who are coming into MTD for income tax is the 5th of April 2024. So unless you're exempt, and there are very few people who I think would consider themselves to be exempt, that's broadly income below £10,000 from self-employment or property, you really need to start considering what software you're going to be using.
And there's also an ICAEW webinar, I think, on the 30th of November that's going to cover a lot of this. So do look out for the link in the show notes to that. Anita?
The ICAEW has put together a webinar programme, and I've been talking to my colleague Caroline Miskin, and we have decided that we're going to kick off with a super webinar, 1.5 hours, to get all our members back up to speed with what the MTD requirements are, all the key dates, all the new penalty rules, what's happening for VAT, the income tax self-assessment rules, and then next year we're going to be having a regular monthly MTD webinar that will be available to all ICAEW members, so people will miss nothing.
It's going to be a blockbuster, Tom, I can assure you.
Oh, indeed, yes. Linked to MTD then, we've discussed the government's basis period reform proposals on this podcast before. I guess basis period reform is the next challenge then?
Well, I think it's fair to say that the jury is out at the moment as to whether the government is actually going to proceed with basis period reform. There was the consultation over the summer. ICAEW's view was that the government should not proceed with it. And that was for a number of reasons, but primarily over 70% of businesses wouldn't be affected by the change in the first place. So I think there's a sort of basic position of if it ain't broke, don't fix it. But the problem was that the people who are affected potentially are very badly affected. And potentially it's an international competitiveness point, because a lot of the businesses who you are looking at here would have 31st of December year ends because, for instance, they are international legal or accounting partnerships who are constrained by their international obligations. So for those businesses, it would be a potential real difficulty because you'd be increasing the amount of uncertainty and you potentially would be using estimated figures. So I think at the moment, the government has said it won't be introduced before the introduction of MTD, which is welcome. But I think our view is that we still don't think this is something the government should pursue.
I mean, they have said, haven't they, that it would be with effect from 2024-25 if it goes ahead, with the 23-24 year being the transition. I think what's bothering us very slightly about this is that if they've gone to all the trouble of explaining when the transition would be, it's clearly on somebody's agenda still. I mean, we're expecting to hear more on Budget Day, aren't we? 27th of October. So that's going to be one to watch. One interesting point, I think, on basis period reform is that HMRC has said very clearly in words of one syllable to us that this is not about getting tax in earlier. And I do wonder whether, given that we know there is tax at stake here, the timing of tax payments, whether perhaps other ways of dealing with this particular issue might be being considered. So it'll be interesting to see.
Overlap relief, does that continue to be a bug in the system?
Overlap relief is currently a problem, largely because it's been hanging around for so long that many businesses have forgotten how much overlap relief they have. HMRC has said that it will be able to give people the number if they need it, but I am not entirely sure that is true for all.
And I guess, on a broader point, the more time to prepare businesses for what is likely to be a steep learning curve. You mentioned just now, Anita, that a lot haven't even started preparing. So that can only be a good thing, I guess. Use your time wisely, perhaps.
Yes, I think that's right, Tom. One of the issues that our members are still grappling with is the aftermath of the COVID schemes. And it isn't just those that have been dealt with by HMRC, it's paying back all of the loans, it's working out a time schedule for tax that perhaps had been deferred. And our members are helping businesses to work out how to deal with that. They haven't really got time also to be doing fundamental reviews of how businesses keep their accounting records. I think we are going to see a lot of people using spreadsheets as the sort of short-term solution.
Let's move on now to an equally long-running theme in the lives of chartered accountants, life after the EU. There were those who felt that the UK's departure from the European Union would free it up to explore opportunities in areas like VAT. Are we likely to see any VAT changes in this budget? And is VAT likely to change further in the medium to long term?
Well, you've got all the difficult questions there, Tom. It's a very good question, though. I think at the moment there's no obvious sign that the government has much appetite to actually amend the VAT rules. You might think that was fairly sort of counterintuitive, given that it's a great way potentially of raising money very quickly. We've had examples of them putting 2.5% on the rate with effect from the following month. And I think, 1% on the VAT rate introduces about 5 billion or so. We're talking big numbers, but the government doesn't seem to have much appetite at the moment. And I think that's probably for a number of, two particular reasons, probably. The first one being the fact that they're constrained by their manifesto commitment that they wouldn't raise the headline rate of VAT. You might say, well, we've already seen an example of them breaking that with the Health and Social Care Levy and the NIC. But nevertheless, that was the commitment, and we've obviously seen quite a big backlash against that as well. So I think they'd be somewhat circumspect about doing that. And I think the other thing was that when we were moving out of the EU, the government did say that it didn't want to make major changes in the short term to VAT because, going back to a point we've heard a lot of, it's stability and certainty, and businesses really are crying out all the time for stability and certainty. And times are uncertain, having left the EU, and I think the government probably would be quite careful not to make major changes to the VAT system in the short term. And as I say, they've made no sort of signal so far that they have any intention to do so.
I think there is one area of VAT that everybody is still talking about, and that is the need for simplification. VAT is a very complex tax, and I suspect that we will be coming back to talk about the exemption again in the near future. Possibly not immediately, but we can, for example, cite partial exemption calculations as being particularly difficult for many businesses to have to work with. But there are going to be winners and losers. And of course, we haven't finished negotiating all our post-Brexit deals. So to be touching in what are essentially international taxes at this stage, I think tread with caution.
I think tread with caution, isn't it? And partial exemption, an obvious simplification benefit, but as Anita said, not only is it winners and losers, but how do you apply it? So, for example, financial services are currently exempt, but how do you actually apply, or how would you take away the exemption? How would you apply it in a financial services context? So there's a whole raft of considerations that will be needed before you actually started to go and actually consider whether the exemptions needed to be removed. And they're all there for social reasons as well, which makes it doubly difficult.
But Frank, don't you think it's time to deal with the Jaffa Cakes question once and for all?
But that's zero rating. That's another question entirely, isn't it, as to whether we should remove zero rating, which on the face of it would be much easier. But the moment you mention children's clothes, food, it's a very emotive subject.
Well, I've got small feet. I'd vote for keeping children's shoes.
Well, before we're accused of having our cake and eating it, we'll move on to free ports. Now, free ports are Rishi Sunak's new initiative to help growth and innovation, but details about exactly how they'll operate seem to be slow to appear. What do you think, Frank, and what are the benefits businesses should be looking out for?
Right. Well, free ports, Rishi Sunak first produced a paper back in 2016 when he was an unknown MP about free ports. So it clearly is his baby, and he does think that it's going to be a major step forward in the UK's drive to sort of improve innovation, levelling up. But it does seem a bit slow, I think, in terms of the actual progress. I mean, we are seeing some coming through now. We've obviously had 8 free ports announced in the last budget, and I think what we'll probably get in this budget is sort of further a sort of progress check. And we have, I think, had Thames Port has already said that we've got an operator now for that. So I think he'll be sort of setting out a roadmap for when they start. But in terms of benefits, I mean, they obviously have customs benefits in terms of the ability to defer duty and potentially get lower rates of duty if you do processing. But I think the general view is that by themselves, the sort of customs benefits probably aren't that great. And it's really the tax benefits and the tax sites that people are really going to... I mean, effectively, we're old enough, Tom, to remember enterprise zones, where you have effectively enhanced capital allowances for both the structures and buildings allowance and also the capital allowances. So we're going to see 100% capital allowances and 10% structures and buildings allowance, which are, they're a significant improvement on the current rates. And we're also potentially going to see there will be a national insurance, 3 years, employers' national insurance as well, 0% on the first 25,000. So there's lots of benefits in there. But the sites, we're still waiting for the designation of the actual tax sites within the free port zone. So, it's still a bit early days. And a question we've only just come up with is how is the health and social care levy, for instance, going to interact with the free ports NIC legislation? So that's question number 51, I think.
Goodness, well, we'll see how Rishi Sunak brings that into doc during the budget speech, hopefully. Anita, you touched on this a little bit earlier, but dealing with sort of the tax authorities and the sort of ongoing administrative issues around COVID schemes. You mentioned dealing with the aftermath is potentially more challenging than the original claims. Can you expand on that a bit, please?
What we're hearing from our members is that it is very, very difficult to get answers from HMRC at the moment, either by phone or to letters or to claims. The whole system is really creaking. It's understandable because HMRC has had to operate the COVID schemes, and now we are in the process of seeing them unwound, and there are lots of cleaning up jobs to be done. For example, with the job retention scheme, we've got overclaims and underclaims. People are being asked to go through and look very carefully at the amounts they've claimed and pay anything back that they've overclaimed or just don't need. We're seeing lots of letters being sent out to businesses, and employers are being asked to check their claims. So HMRC is very, very busy. It doesn't have tons and tons of extra resource. And in fact, the danger is, as we've heard, that HMRC may find its resources cut in the spending review. So I think we are in for a tough time ahead. The administration of tax is the boring side, it's the less sexy side, but it desperately, desperately needs adequate resource. And if I had one request to Rishi, it would be don't reduce HMRC's budget anymore.
Finally, on the tax front, with the COP26 climate conference in Glasgow coming hot on the heels of the budget, there's going to be pressure on Rishi Sunak to ramp up the government's green agenda. What role will tax play in the ambitions to reach net zero?
The one thing, again, and going back to a point we've already made, is that I think we need a clear roadmap. What's the strategy for green taxes and encouraging us to get to net zero? Because I don't think at the moment we've got a hodgepodge of all sorts of reliefs here, enhanced or capital allowances for green energy, but there's no coherent roadmap for this. And businesses, I think, again, need stability and certainty so they can actually plan. So at the moment, I think it's fair to say that we do need that. But interestingly, if you look at the figures for so-called green taxes, actually, in net terms, they've literally stayed static or potentially declined over the last 10 years. I think it's currently about 45 billion is raised through green taxes, although arguably some of those, for instance, fuel duty, is a major revenue earner. So there's also this really difficult question as the tax system is there to raise tax, fund government expenditure, and we know it's not been meeting all the expenses for, I think, 20 years. So we've got a system already that isn't meeting all the government's expenditure needs in terms of raising revenue. So it's a very difficult balance, I think, to get, because obviously, the more green taxes you have, and if they're successful, the less revenue you're going to get from them. So you have a sort of fundamental dichotomy there at the heart, if you like, of the government's spending programme, which I'm not sure we've really got to grips with.
Anita, you wanted to come in?
Yes, I would like to see the Chancellor in this budget have to identify which of the new tax measures are there to change behaviour, make us a bit greener, and which are there to simply raise revenue. Because, as Frank's mentioned, there is a seesaw effect here. And if we're out to change behaviour and we succeed, we will no longer have revenue from that particular measure.
Indeed, on the basis of the green tax figures for the last 10 years, you might say the government or the policy has been successful, because if they're going down, surely we must be getting greener. But that doesn't seem to be, I think, what most people think. So I think there's some fundamental challenges here, and ultimately, is that tax system the right way of actually encouraging changes in behaviour?
Well, that's a question for another time, I'm afraid. But thank you very much, both. You can find more details about all the aspects discussed with Frank and Anita on ICAEW Insights, ICAEW's tax faculty pages, and ICAEW's dedicated Budget 2021 hub. Links are available to all these in the show notes to the podcast, as well as information on ICAEW's super webinar series mentioned during the chat. We're going to devote the second half of this podcast to the public finances and public spending side of the equation. After experiencing one of the worst economic recessions in 300 years, and with fiscal policies still supporting many businesses and individuals, there's a concern over how the government will finance the large amount of debt incurred during the pandemic. To help us get to grips with some fairly eye-watering numbers, I'm joined by Martin Wheatcroft, an advisor on public finances who works closely with the ICAEW public sector team. Hi, Martin.
Hi, good morning.
And still with us is Alison Ring, Director of Public Sector and Taxation at ICAEW. Let's start on the public finances side of things. Martin, how much headroom has the Chancellor got?
Well, in terms of COVID support, he's got plenty of headroom. The actuals are coming in better than expected this year, and the IFS have just reduced their forecast substantially. However, it's a very different story when we're talking about the spending review and the core departmental budgets that are going to be paid for. So he can borrow cheaply, but interest rates are going up. But the pressure on public spending is intense. We're going into a very difficult position. He's putting in new fiscal rules that should constrain his options, but history is that they're generally not met. So we'll have to see there. And the longer-term issues remain. More people are living longer, less healthy lives, and proportionally there are fewer workers to pay the taxes that are needed. So that makes for some very difficult choices.
Indeed, yes, long-term planning needed. Obviously, the government has been preparing for this for some time. What do you think the Chancellor is most worried about, Martin?
First and foremost is the pace of the economic recovery. Falling business investment will be a big issue if the current issues that we're seeing in the economy follow through. On the spending review, which is primarily about the core departmental budgets, that's one part of the equation, and then you've got all the welfare spending and universal credit and so on. So the cost of living crisis is a major issue this winter, and that will put a lot of pressure on the budget, particularly on the welfare side. The Chancellor will be thinking about whether he gives any support through universal credit, perhaps reversing some or all of the £20 cut that have just come in. He'll also be very, very concerned about both inflation and interest rates. With a much higher debt pile that we've accumulated since the financial crisis and COVID, we're now much more vulnerable, or the public finances are much more vulnerable to changes in inflation and interest rates, and that will increase the costs and therefore squeeze the amount he's got available to meet other policy priorities.
Let's move now to the spending review 2021. As I mentioned at the top of the show, the first 3-year review in 6 years, where the government will consider its priorities across all spending over multiple years. Martin, what are we expecting in the spending review?
So primarily what the spending review is about is the allocation, the split of the budget between departments. The Chancellor has already announced the total amount of core departmental spending, which is going up to £409 billion a year in the coming year. But the key thing is how much will be actually allocated to key departments like justice and the court service, for example. A lot of that's been pre-allocated. The IFS last week suggested that over 64% of the budget is already allocated and taken up by health and social care, schools, defence, aid, leaving only just over a third of the budget to actually play around with. And of course that makes it very difficult. If you give more money to courts, do you take it away from the police or take it away from other public services? And local government budgets are under particular strain at the moment, so you've got some big issues there.
So as part of its normal submissions to government, ICAEW wrote to the Chief Secretary to the Treasury. Alison, what did ICAEW say?
We absolutely need a steady financial platform for delivery, particularly around the area of net zero, where there has been little said at the moment. Stable funding. So what people want, what councils want particularly, is certainty. So capital budgets beyond 3 years and a complete rationalisation of local government funding streams. There's too many pots to apply for and it makes it very complicated for local government. Fiscal resilience. So we need a clear strategy to actually strengthen the public balance sheet. We need more resilience in the government machine, and that's also including recapitalising local authorities. And last but by no means least is the financial capability to do all of this. So there needs to be greater investment in financial and risk management skills. That's in central government and in local government, and in the systems, the processes, and in internal and external audit.
Thank you, Alison. So, Martin, what spending areas are you particularly looking for in this?
I think the local government settlement will be quite interesting. That's quite key to the levelling up agenda, and how that plays out will tell us a lot about how the government intends to move forward over the next few years. The railways will be quite interesting. I think what happens with HS2 and Northern Rail investment. The spending review does include quite a substantial amount of new capital investment, so that's going to be quite interesting. And there is more room the Chancellor has on capital spending, so we are expecting quite a few announcements around investment. There are rumours of cuts in administration budgets, so that's going to be interesting to see how they can both cut administration, hopefully make the civil service more efficient and still deliver what are quite ambitious plans. And I think another key area will be education, where, again, the levelling up agenda tends to suggest that there should be quite a big focus on further education and apprenticeships.
Fantastic. Thank you both. And you can find more details on the spending review and public finances on ICAEW Insights, ICAEW's public sector pages, and the dedicated Budget 2021 hub. Links are available in the show notes to this podcast. And I'm afraid that's all we have time for today. My thanks to all our guests, Frank Haskew, Anita Monteith, Alison Ring and Martin Wheatcroft. Thank you very much for listening, and we hope you'll tune in next time. Bye for now.
We hope you enjoyed this episode. If you want to hear more from ICAEW, subscribe on Apple Podcasts, Spotify, or wherever you get your podcasts.